Definitions. Why is the topic relevant for organizations? The investor relation is intended to provide investors with open and complete information on developments in and around the company, thus creating confidence in the management. Ultimately, investor relations should enable the investor to recognize the fair value of the company. What effect do we want to achieve? What is required is a transparent, investor-oriented information policy on the part of companies. An important keyword in this context is the shareholder value approach and, increasingly, the concept of corporate governance. Corporate governance demands a balanced distribution of power between management, shareholders, and company supervisory bodies. The balance of interest between management and shareholders has a direct impact on the performance of companies and on whether they can generate profits, create jobs, and create competitive advantage. In summary, the investor relation is about minimizing information deficits, generate a fair and full valuation of the stocks and bonds in the marketplace, and avoiding risks and crises. As the budget increases, so does the expectation on the part of management that such a profit contribution will be shown. Investor relations should therefore also be able to present its value and significance for the company in a comprehensible manner. There can be several problems of displaying the value. Making communication measurable in one form. Measuring the impact of investor relations requires a whole range of methods, from media analysis and media impact research to researching the impact on the behavior of market participants. Also, translating the measurements into monetary values and thus enable classical controlling. Success control creates a solid basis for further planning for communication control. Without success control, corporate communication becomes arbitrary and random. If these effects are compared with the investor relations objectives, such a measurement of success results, provided that a connection between cause and effect can be proven. Impact and success measurement then serve to check all investor relations activities against the set targets. This shows the importance of strategic objective for investor relations. Without a concrete or written objective, no performance measurement can take place. This is a scheme from the neighboring discipline public relations, which can easily be adapted to the effects of investor relations. You can distinguish between considering the instruments of success control or the communication transmission, so output and outgrowth, and the actual success in the sense of the effects of communication, so outcome and outflow. Output. Pure production performance of corporate communication is measured quantitatively. Number of performed conference calls, number of press contacts, etc. Outgrowth. Quantitative and qualitative measurement of perceptions among target groups. Was the communication performance recorded and understood? Outcome. The effect of the recorded information on the attitudes and behavior of the target groups is measured. Measuring instruments are, for example, perception studies and advertising impact researches. Outflow. Does the change of attitude and concrete behavior have an influence on the added value of the company? Measuring instruments are, for example, advertising impact research. The first three levels thus capture the success of the investor relations at different levels of aggregation. And the outflow level, the monetary influence of attitude and behavior changes is recorded. Instruments for measuring success and value contribution. Quantitative methods. Share price. Disclosure of information leads to high transparency, which leads to high trust, so the risk discount is lower. Volatility. Expectation management should keep volatility low. Shareholder structure. The shareholder structure can be influenced accordingly through targeted addressing. Cost of capital. Low volatility leads to declining capital costs, so future cash flows are discounted at a lower rate, so shareholder value rises. The target figures are measurable, but a direct causality between investor relations and these figures has so far hardly been conclusively proven. For this reason, the practice helps itself with qualitative methods, which are usually easier to implement. Qualitative methods. Feedback from analysts and investors. By interviewing analysts and investors, conclusions can be drawn about the quality of the investor relations. Perception studies. Perception studies use surveys of capital market participants to determine whether the messages communicated by the investor relations have been received correctly by professional capital market participants. Media monitoring and media resonance analysis. The media monitoring instrument is used to record the frequency of reporting. By means of media resonance analysis, the reporting is also analyzed for correctness and interpretation in terms of content. Investor relations ratings. Reuters publishes annual ratings that reflect the opinions of analysts, fund managers, and private investors on criteria such as timelines, credibility, and quality.
Let's come to the next point, the communication object. A company is judged by its financial performance and its growth potential. Financial communication can help to communicate this through raising awareness of a company's activities and business strategy, and profiling its management. So first of all, we want to give you a short overview over the most important financial key performance indicators. First, sales. This is the earnings minus costs. Second, the operating profit. It is the most important earnings indicator as it expresses the success of the core business. The calculation, you take the operating revenue minus cost of goods sold, minus operating expenses, minus depreciation and amortization. The third indicator is the EBIT. It stands for earning before taxes. You calculate it with the net income plus interest plus taxes. The EBITDA also includes depreciation and amortization. Next one is the profit warning. It is a public announcement made by a company to shareholders and others, warning that profits for a started period will be much lower than had been accepted. The return on sales represents the profit share related to sales. This key figure thus shows how much the company earns in relation to €1 sales. The calculation in percent is the profit multiplied by 100 through the sales revenue. Last but not least, the cash flow. It makes the cash inflow transparent. Cash flow is a measure of the self-financing power of investments and the willingness to pay.
The communication also involves managing financial market expectations of a company. Investors will use the available information about a company to try and predict how it will perform in the future. For example, if financial markets using information given by a company predict a 20% growth in profits and that company fails to meet the prediction, The result is disappointment. That leads to investors selling their shares and may discourage other investors from buying, which will lead the share price down. Analysts rely on companies to provide clear information that allows them to make realistic predictions about a company's future performance. New regulations have encouraged business to be much more careful and cautious about future forecasts.
Let's come to the next point, when to communicate. There are 4 types of communication, according to the financial calendar, outside the financial calendar, during transactions, and the ongoing communication. First of all, according to the financial calendar, all listed companies have a financial calendar, and there are 4 tools they use. First, the preliminary results, the annual report, the half-yearly results, and the annual general meeting, also known as AGM.
These are the times the listed company is legally obliged to disclose its financial performance. Announcements also provide an opportunity to build strong relationships with financial audiences.
So first, the preliminary results. This is a shortened version of the annual report. The annual report, also called annual accounts, is a presentation of a firm's audited accounts for the preceding year as required in corporate legislation. In addition to the auditor's report, an annual report commonly includes management's review of the operations of the firm and its future prospects. Also the balance sheet, the income statement with the profit and loss account, the cash flow statement, and other supporting documents.
The half-yearly results. A company is also required to report its half-yearly figures in the same way. The annual general meeting. The meeting can be held at the company's head office or another suitable venue, but it should take place within 6 months of the company's financial year end. The AGM offers an opportunity for shareholders to meet face-to-face and ask direct questions of the company's senior management. The annual report needs to be formally accepted, directors re-elected, auditors appointed, and the company may use the opportunity to make a presentation on the results and plans for the next year.
We decided that we would search the world for a partner who authentically loved tea, a partner whose level of trust in the world is second to none, and a partner who shares our commitment to giving back and the sense of humanity. Please welcome Oprah Winfrey! Before Mother's Day, 2 weeks before Mother's Day, in every Starbucks store, every Teavana store, Oprah Chai beverage, Oprah Chai in whole leaf tea, and we're going to change and transform.
Oprah Chai latte at Starbucks.
That's true.
Yeah.
Everyone's going to get a sample of Oprah Chai.
Wait. Teavana? No. That's not how you say it.
Okay. Sorry.
The way you say it is, you get a chai, you get a chai, you get a chai, you get a chai. Try it, come on.
You get a chai, you get a chai, you get a chai.
Everybody gets a chai! So let's go down the line. Black pepper.
Yep.
Chicory. Cardamom.
Yes.
Cloves.
Yep.
I like things really spicy. I like things chied up.
Cheers. 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 Cheers.
Oh, now that is tea! Yay!
Our next point is the communication outside the financial calendar. The analyst site visits to see the operations of a company. This helps creating a greater understanding about a company. Analysts get better feel of how the company works, and they have the opportunity to meet the management below board level. There are also meetings with private client brokers. If company has a large number of private investors on its register, or if they would like to have more. When hosting visits and meetings, it is important that the company don't disclose any information other than what is already in the public domain. Let's come to our next point, the communications during transactions. There are 3 types of transactions we want to talk about: flotation, mergers and acquisitions, and hostile takeovers. First, flotations. This is when a company decides to have its shares listed on the stock exchange, also known as an initial public offering. A broker and a corporate financier will be appointed to manage the technicalities and marketing of the offering to institutional investors. PR support helps handle media relations and reputation management during the process. As you know from the last week's presentation, it is also very important to communicate during mergers and acquisitions. So we go straight on to the hostile takeovers. May be launched when the directors of one company resist the advances of another. These can be complicated and very bad-tempered, with PR representatives of both sides engaging in a war of words through the media, analysts, or direct with stakeholders.
The last point, the ongoing communication. The immediacy and depth of investor relations information that is available to all investors has been transformed in recent years by the investor relations part of a company website. These are now extensive productions with detailed presentations on all activities of the organization. A key feature of these sites is that they include a wide range of webcasts and presentations. They also have a range of features allowing investors to be kept up to date with new announcements via RSS feeds and email alerts. The investor relations site on company's website allowing best practice to be observed. You can find a complete calendar of an IR manager on our handout document. Our next topic are the stakeholders of the financial communication. They are called financial audiences and also known as financial community. The financial markets are extremely complex and interconnected and develop a wide range of intermediaries who play a key role in the whole process of capital markets. Each of these can be an important stakeholder for companies' communication financial information and building long-term relationships. To the financial audience belong the institutional investors, the new capital sources, the media, and analysts.
Our first point, institutional investors. Main investors in quoted companies are large institutions, for example pension funds, insurance companies, or investment banks. When individuals put money into pension funds or insurance policies, it goes into bigger pots of money, called funds, that are subsequently invested in listed companies. Large institutions are influential investors because they hold a significant stake in a company, anything between 1 and 20%. The relationship with the institutional is actively managed by its investment team, in-house and external, as well as by broker or investment bank. Let's go on with the new capital sources like hedge funds, venture capital or private equity. Financial markets have innovated and developed significant new sources of capital and investment over the last 20 years, which have become important influence in quality businesses, especially during times of difficulty, for example, restructuring or in mergers and acquisition. New capital sources such as hedge funds became highly controversial as many have short-term trading strategies. This is making an investment strategy for an organization difficult. However, the power and influence of these capital sources, even though controversial, have become key audiences for financial communication teams and are now a regular feature of the investor relations team. The short-term nature of some of this capital made the monitoring by investor relation teams of an organization's share register a key area of activity to spot share building.
Another important stakeholders are analysts. These are a key opinion former, identifying trends and analyzes and generating ideas for investments. There are two types of analysts, buy-side and sell-side. A buy-side analyst only works to provide information to fund managers working either for these large funds or independently. Sell-side analysts work for the brokers or investment banks who look after listed companies. However, recent trends here enhance the influence of the buy-side analyst and weaken the influence of the sell-side analyst. Both types provide independent analysis about the workings and prospects of a company and the market in which it operates. They usually specialize in a particular sector and will make recommendations about whether shares in a particular company should be bought, sold, held, or avoided, making them an important audience for listed companies and their financial communications. It is the unique responsibility of financial communications to encourage and manage the relationship between company and the analysts who follow it. A financial communications person is most likely to be the first point of contact between company and analysts and will be the gateway for subsequent information gathering. Analysts have an important relationship with the press. Journalists can add weight to an article by quoting an analyst. An analyst will also watch key press like the Financial Times, the Wall Street Journal, and key national media, as well as key trade media for new ideas or independent information in companies and sectors. The growth of social media, particularly specialists' blogs, also provided new sources of information and ideas for analysts.
The last stakeholder is the media. Analysts, the markets, investors and potential investors rely on the financial news media, both traditional and digital, for additional key information about a company or industry. Traditional media has been augmented in many ways, replaced by the growing role of digital media. The financial media as a whole has great freedom of action, greater legal protections, and sometimes more resources to pursue corporate information than do investors. Journalists frequently are among the first to discern trends and discover change within a corporation or industry, and it's therefore important for investors making investment decisions to pay attention to the press. Given the leading role media plays in investment decisions making, investor relation and corporate media relations naturally focus considerable time and energy attempting to inform and generate accurate and positive commentary for a corporation, its management and its prospects.
Role of communication. As investor relations in Germany is still one of the younger professional fields, there has been no standardized training to date. Since 2002, the German Investor Relations Association offers a continuing education program under the name CIRO, in which the relevant background knowledge within the framework of a 6-month extra occupational study courses is mediated. Demands: completed studies in the field of economic sciences, knowledge of capital market law, experience in the areas of accounting and/or controlling, very good knowledge of the German and English language, secure handling of standard office applications, strong communication skills, and analytical thinking skills. Tasks. The tasks of the Investor Relations Manager include, above all, compliance with post-admission obligations. This includes the holding of the annual general meeting as well as a possible announcement of dividends, the preparation and publication of financial reports, Then, monitoring and appropriate publication of insider information, communication of directors' dealings, and the preparation of the annual document in accordance with the Securities Prospectus Act. Legal requirements for the financial communication of companies. In addition to the German Commercial Code HGB, the International Financial Reporting Standards IFRS in particular have gained in importance. National accounting rules. The accounting regulations of the German Commercial Code HGB are traditionally geared to creditor protection. A true and fair view of the net assets, financial position and results of operations should only be given within the framework of generally accepted accounting principles. International accounting rules. The primary objective of IFRS is to satisfy information needs by providing information useful for decision making. The annual addresses are the shareholders, lenders, and other stakeholders.